This is your technical update from the LMAX Exchange Research and Analytics Desk for Wednesday, November 4th, 2015. Euro dollar. So right now the pressure clearly remains on the downside, with the euro focused on a retest of next key support in the form of the July base at 108.09 further down. At this point, if we do see any rallies to the top side, they're classified as corrective. Ideally, we see some resistance into some former support around the 111 area, though there is risk that the market overshoots up towards 113. But ultimately, the market should be very well capped into rallies in favor of that next downside extension below that 108.09 July low. Sterling dollar. So cable remains confined to a broader downtrend off that 2015 high at 59.30, with the market putting in a series of lower tops, the most recent confirmed lower top at 156.59. But in recent sessions, we've seen the market stall out in the 155 area, and so this is the ideal next lower top ahead of a resumption of declines back down towards and eventually below recent lows at 151.07. Dollar yen. Despite any gains in dollar yen in recent trade, the market remains confined to a consolidation over the past few months, with the consolidation being classified as a bearish consolidation given that intense breakdown that we saw back in August. So long as the market holds below 121.74 on a daily close basis, the pressure should remain on the downside, with a focus on an eventual retest of the August low at 116.12. Euro Swiss. So Euro Swiss hasn't been doing much over the past few months, although the market remains confined to a broader recovery outlook since recovering out from those record lows earlier this year. At this point, an eventual break above the highs that we saw going back to September at 110.50 is sought out in favor of the next upside extension towards 112. At this point, only back below 107.14 would negate this outlook. Aussie dollar. So Aussie has been bid up over the past few sessions, though the market remains confined to a broader downtrend, and any rally should continue to be very well capped below 74.40. Really, only a breakback above 74.40 would compromise the immediate bearish outlook. Dollar CAD. So dollar CAD has pulled back in recent trade, although the market has since bounced from significant previous resistance turned support in the 128 area, and the overall structure remains highly constructive. Ultimately, any setbacks should be very well supported ahead of 128, with only a breakback below this level to negate the highly constructive outlook. At this point, look for fresh upside back towards and eventually above the recent highs that we saw, those 11-year highs at 134.57. Kiwi dollar. So Kiwi is finally showing signs of stalling out after the market rallied up towards 70 but stalled out just shy, and is now carving out a medium-term, what looks to be a medium-term lower top ahead of the next downside extension and bearish continuation back down towards those recent multi-year lows in the 62 area. At this point, only a breakback above the 70 area would compromise the immediate bearish outlook. SPX 500. So the S&P 500 continues with its impressive recovery from the August lows, now trading back above 2100 and very close to that 2137 record high from May. But daily studies are looking a little bit stretched, and the market does look overall extended on a longer term basis, which could open the door for a bit of a pullback in the coming sessions. But we need to see a break and close back below recent lows in the 2058 area to officially put the pressure back on the downside. Gold. So gold has seen some sharp setbacks in recent trade, though if we look at the chart, the market has now traded into some key rising trendline support off that multi-year low that we saw earlier this year. Look for the market to hold up somewhere above 1100 in the 1120 area in favor of the next upside extension, a higher low and upside extension back above recent highs around the 1192 area and towards 1233 further up. Really, only a close back below 1100 would negate this recovery outlook for the gold market.